moved higher since the lows after Christmas. Fixed income on the sovereign side has not followed that same path. You saw the 10-year Treasury come down dramatically, but we think that this is a scenario close to what we saw back in 2016, where you had the February lows. All three of those markets moved higher. 10-year Treasury yields continue to come down for the remainder until June of that year, before resyncing with what those markets were saying, which was risk on. So that 10-year Treasury has been being brought down for a couple of different reasons. The first is that you had record short positioning in the Treasury market. As that was unwound, it exacerbated the move down lower. But also the 10-year Treasury isn't just the US benchmark, but it's the global benchmark, and it's been foreshadowing some slower global growth and slower inflation expectations.
And this bifurcation between the fixed income and equity markets, do you expect that to go on longer term?
We don't. We think that as we move through the year, the 10-year Treasury will start to rise on a couple of different variables. We do see global growth starting to trough and move higher in the back half of the year. That should push the 10-year Treasury higher. We also believe that the change in Fed policy may be at hand as well. The Fed is going to be reviewing their 2% inflation target, and from being trying to hit a 2% inflation target to moving to an average of 2% over the medium term. So if they do that review of their inflation framework, that should steepen out the 10-year Treasury as well, because you need to embed a little bit more of an inflation expectation in that yield.
Well, you made a great point in the note that you published recently, that the yield curve in isolation doesn't work quite as well as a forward-looking indicator, if you will, unless you put it together with a combination of other indicators.
Yeah, I think there's a little bit of a misconception that the yield curve is never infallible, but you did have two false positives in 1998 and 1966. But also with the recession risk dashboard that we have at ClearBridge, we like to use 12 variables to be able to tell whether or not the economy is about to roll over. And if you think about the yield curve, it's the 5th ranked variable in our dashboard. It's not even a top 3 because of the inconsistency of when that inversion means for the peak and the eventual recession.
So what else are you looking at? What are the top 3? What are the other ones that you're looking at?
Yeah, real retail sales is a top 3 variable, jobless claims, and also credit spreads. Credit spreads have come in about 150 basis points from the highs that we saw in early January, so not all fixed income investors are quite worried right now.
All right, and let's go back to the Fed policy. FOMC minutes were just released about an hour ago, and doesn't look like much has changed, as you had suggested.
Yeah, I think the Fed's on pause for the foreseeable future, with the Fed actually taking 2 hikes out of their dot plot expectations a couple of months ago and bringing an earlier end to their quantitative tightening program. That had the effect of a rate cut for monetary policy. But in fact, if you think about the last rate hike that we've seen in the last 8 tightening cycles, typically that first rate cut happens less than 5 months after the last rate hike. And right now investors are pricing in about a 55% chance of a rate cut in 2019. So we don't see a cut in the forecast, but we think what the Fed has already done is the equivalent to a cut.
Yeah, I mean, it's been a very different story from what we saw in 2018. Let's wrap it up here with the divergence between the U.S. and global economic data. It's 2 very different stories.
Yeah, the U.S. has slowed a little bit, but you've seen much more slowing emanating from China in the manufacturing sector. But it's important when you look at the international space that you are seeing a bifurcation in the services data and the manufacturing data. Although manufacturing has been coming down for the better course of a year, the services data has held up very well, all things considered. The one thing that could cause a little bit of volatility in the second quarter is that I don't think that we've seen the worst of the economic data coming from China. I think manufacturing data will continue to weaken in Q2, which may cause investors to take some profits from a pretty robust rise that we've seen here over the last 3 months.
Do you think that gives us leverage when it comes time to discuss trade deals with their economy not quite doing as well as ours?
Sure, I think it was very good timing. Obviously, we had the Tax Cuts and Jobs Act that gave us a nice boost in 2018. Our economy is holding up relatively well. Their economy was going through a slow patch because of the deleveraging efforts that were going on with President Xi's plans. But moving forward, we do think a trade deal will likely materialize sometime over the second quarter. All of the narrative that we've heard from our contacts in Washington suggests that sometime over the next 3 months, a trade deal will be forged, which should give a boost to the market sometime in the late second quarter.
All right. It'll be interesting to see where we are when I talk to you in Q3. Thank you so much, as always, for joining me.
Thanks for having me on.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.